In this short video, I want to take on a role that's vital to equity investors and vital to financial markets generally, and that is stock exchanges. More specifically, I'm going to focus on the London Stock Exchange, where it came from and what it does. So, why do we need exchanges? Well, here's a very short, sharp scenario. I want to buy 100 shares in TIM plc. Sounds like a relatively straightforward instruction, but what could go wrong? Quite a lot. First of all, who is TIM plc? Is anyone vetting who TIM plc is? Is it a company I can rely on? Is it a sham company? Is it well established? Has anyone set boundaries on the shares that I can buy without losing my money? Next, what price am I going to pay for TIM plc? Is there an easily available market price? Am I going to have to negotiate with a counterparty? Who's my counterparty going to be? How quickly can I get a deal done? Even if I can agree a price and number of shares in TIM plc that I want to buy, how am I going to guarantee that delivery of the shares takes place from the seller to me, and how's the seller going to know that I'll deliver the cash at the right time? Well, to be honest, prior to exchanges, an awful lot of that was frankly left to chance. So, the reason exchanges exist essentially is twofold in essence. One, if you shop on an exchange, such as the London Stock Exchange, you are only buying certain types of company. The exchanges have vetted the companies that come to them by what's called the primary market, issuing new shares. And you know that deals that are done via a stock exchange are likely to be done at a reliable market price, and delivery and settlement, as it's called, of the cash and the shares will take place. And that's why stock exchanges usually limit who can access them to what are called members. Okay, members of the London Stock Exchange, that's not everyone in the world, but certain firms can get membership of the worldwide exchanges. So there you have it. A way, first of all, to make sure that the likes of the TIM PLCs have been in some way vetted. Nothing's guaranteed in life, doesn't mean something couldn't go wrong. And secondly, restricting membership and therefore increasing the likelihood that deals are done and completed on time and reliably. Okay. So where do you find exchanges? If you were to look around the market, what sorts of things trade on exchange? What sorts of things trade over the counter or off exchange? Because there are two basic ways to get a trade in most things done. Okay, if they're available on exchange, then fine. Lots of trades probably happen there, and that's probably because they're fungible. There are lots of things that are roughly the same. It's a liquid market. It's relatively easy to trade one for another. Okay, and that tends to apply to shares, hence London Stock Exchange, New York Stock Exchange, and so on. Bonds to an extent. Quite a few bonds are traded privately between institutions, but increasing numbers are available to retail investors through exchanges such as the London Stock Exchange. Commodities, over in Chicago, the Chicago Mercantile Exchange, the Chicago Board Options Exchange, big volumes and values of commodities being traded there. Derivatives, certainly. Won't say too much about those in this video, but derivatives based on some of those other products, and investment trust companies. So you can have funds that are called closed-ended, that are listed on exchanges and trade in much the way as other shares do. So effectively you're buying shares in a firm that buy shares in other firms. Now, less commonly, or never if you like, so over the counter, OTC, deals arranged between counterparties away from an exchange. Currencies. In London, there is no sort of London currency exchange, for example. Alternative assets. You don't generally find, art, antiques, wine, and so on traded on exchange. Property. Okay, there is no central exchange like a London Stock Exchange for property. And open-ended funds. So your unit trusts, as they're known, open-ended investment companies. Their deals are done between the investor and the fund via a broker. So just be aware of that. I'm going to now focus in on that bit primarily, London Stock Exchange. Now, brief history. All right, won't go through every aspect of the exchange's history, we'll just give you a flavour here. Basically, trading, as was the case before most exchanges came into existence, started off as informal deals being struck between groups of traders at, in this case, Jonathan's Coffee House. All right, I suppose the equivalent would be sort of Costa or Starbucks today. All right, and that came about as a result of dealers being expelled for rowdy behaviour from what was then called the Royal Exchange. So trading happened informally for a while, but after a while, 1773, those guys wanted to open up an exchange called the stock exchange. All right. Quickly after that, a rule book was introduced. Now that's the idea, as I said, of limiting who can get involved in share trading, minimising the risk of someone just running off without paying or running off without delivering stocks. Also getting together to think about the kinds of companies that might be tradable on such a market. 1836, worth remembering its history now, that we used to have regional exchanges around the UK. Okay, first one's in Manchester and Liverpool, but Birmingham also got a big one over time. And in 1973, those were consolidated back into the London Stock Exchange. We don't have those regional exchanges in the same way. More recently, some key points. 1986, Big Bang. All right, that was fairly key. Fixed commissions abolished. Essentially, overseas firms were allowed to buy up members of the London Stock Exchange, and certainly did so. Brought in the European banks, the American banks. All right, also started to merge the difference between, say, banks and building societies. So quite a few changes. Ended the idea that broking and dealing have to be two separate activities. It's possible to do one within the same house now. 1995, the alternative investment market launches. So for those people who like to buy shares in companies that are not eligible for the main list at the London Stock Exchange, the AIM market was born back in 1995. In 1997, things got awfully quiet at the London Stock Exchange, moving away from people shouting prices and volumes at each other, floor-based trading, to silent electronic order book trading. More about that in a moment. A lot of European exchanges are quiet buildings. You do not have bells ringing, people shouting at each other, colourful jackets like you do perhaps in, say, New York anymore. 2000, 2001, the London Stock Exchange became itself a listed company. It's quite common. So the stock exchange is listed on its own list of companies. 2003, they moved a little bit into the derivatives market. Essentially, big is beautiful in the world of exchanges. They're all looking to fight off their competition, expand by increasing the number of activities they're involved in, and of course, merging with other exchanges, as I've just noted there in 2007. All right, so expansion tends to be the name of the game. The bigger you are, the lower costs tend to be, and so on. So there it is, brief potted history of how the London Stock Exchange got to where it is today. Now then, basic trade life cycle. Where is the London Stock Exchange actually involved in getting a trade done? Well, the answer is at the deal stage. Dealing is where basically you agree the price and the volume of shares involved in a transaction. So I want to buy 1,000 shares, I'm prepared to pay no more than, or I'm prepared to pay the market price, okay? Or you're prepared to sell. It's where deals get matched. That's what exchanges really do. But that doesn't complete the trade. There is two more stages, clearing and settlement. What you tend to find is that firms that are members of the London Stock Exchange can handle, they've got arrangements to handle clearing and settlement. Settlement is actually moving the cash from buyer to seller and the shares from seller to buyer, getting the re-registration done. In another video I cover that aspect of shares, they're registered instruments, and clearing is the kind of post-trade administration, including making sure that nothing goes wrong between the deal date and the settlement date. Okay, just be aware that exchanges are involved here, clearing houses, as they're known, not surprisingly, involved here, and settlement systems such as Euroclear Crest over there. But those two areas are for future videos. Finish off with just a word about how trading tends to happen on exchanges these days. Increasingly common around Europe to have a lot of order-driven trading, electronic trading, order books, deals coming in from buyers and sellers, silently matched automatically. Okay, quick, anonymous. You don't have to declare who you are necessarily through an order book, and tends to suit the more liquid securities in the market. That works where there are lots of buyers and sellers, lots of keen pricing, if you like. Quote-driven, some people see it as the older style of trading, but still very common around European exchanges, certainly common in America, for example. That's where essentially someone posts two-way price for a security, a quote, called market makers often in the London market, for example. It's face-to-face and phone-based negotiation tends to be appropriate where securities are less liquid, more difficult to trade, you've got an awkward deal size to deal with. So just be aware that there is a tendency to move from here to here, but both styles of trading still go on around the major exchanges globally, albeit this one on the left is becoming gradually more common. So there you have it, a quick tour of why exchanges exist, a brief history of the London Stock Exchange, and a quick mention of how deals get done.